What's up, dude? John.
Man, how's the trip?
It's great. Um, well, being perfectly honest, I've always loved Italy. Been in Italy many times. When I left this time, I was like, kind of fuck Italy.
What was
Just,
that?
just it was just too crowded now. The consumer debt has destroyed the world where everyone who's poor and could never travel before is now going in crippling debt to travel. And that's really making all these cool places suck more. It was just like way too crowded. Every Italian cab driver I had tried to scam me, and I knew they were scamming me. Everyone tries to scam me in New York. I'm used to it. So now they're just like, the meter's broken. I'm like, that meter is not fucking broken. You will put that meter on right now, or I'm going to get out of the cab and cry on the corner of the street. So I was just a little frustrated by the end of it. But the countryside's lovely. You really just have to go. Like, my brother got married in a castle in Italy. That
Yeah.
was great. That
What
was
was
a great
that?
experience.
What area was that in?
It was in Tuscany by Arezzo.
Oh yeah, yeah. It's like every woman's dream, right?
Yeah.
It's like
Ironically, getting married in Italy for 25 people was like 5 times cheaper than getting married in New York.
seriously.
Oh yeah, way cheaper. Because like renting a whole like renting like an Airbnb like wedding venue in like, I don't know, upstate New York, which is like an hour outside of the city, is like at least 25 to 50 grand. At
Jesus.
least
Wow.
they just try and rape you. It's a scam, total scam.
All
Italy,
right.
meanwhile, the castle was like, it was like a 30,000 square foot castle, which is like, you could lose people. It was so large. It was 800
Wow.
years old. It was like $1,500 a night, and everyone slept there. No one needed other accommodations, so it ended up being like a really cheap wedding. Ironically,
It's
in a,
good to know. Okay, it's good to know. It's actually good to know. So
they
I
got
did
you.
not think that. Yeah, man. I need those recommendations. But you seem in good spirits, nonetheless.
Oh, I'm always in good
I
spirits.
was gonna say, if I follow you on LinkedIn, I missed the event by the way yesterday. I was trying to make it. I had a conflict with the calendar. How did that go? You talked
Oh,
about
yeah, it was great. It's
some.
it was we talked about fundraising. One of those things where we have a consulting practice that helps people raise money, which is not where my passion lies. It's something I'm good at, and we have worked with a bunch of people, and it's good revenue and all that. But the fundraising consulting is just, it's a rough business. It's sad. You work with a lot of people who are great, but you work with a lot of people who are just real negative Nellies,
Yeah.
and there's really no way about it. It's because it's also just sucks for most people, and most people like their brain melts like 2 months into trying to raise capital. And so it's just like a rough business, even though the success rate of our clients is quite good. So as more time goes on, I'm trying to get out of it. But
Okay.
for the time being, it's good.
Let's definitely pick that up. I mean, I definitely want to talk about all about that you just said. I mean, obviously that's how I got to know you, how I got to through LinkedIn. And it's funny because I joined a startup now, and I'm not doing the fundraising actively, but in a
Mm-hmm.
way I'm almost asking for myself because it's like I'm just sort of learning this now as I watch our CEO do it. And yeah, I think the interesting thing is if you've never been exposed to it, I think I would not even say there's this level of intimidation almost when you start because you think, oh, it's a VC. I kind of depend on them. They have the money. And then what I like about you, what I try to do with this pod is like making all these things accessible and don't
Sure.
intimidate people and basically demystify it as well. And I think again, you do a fantastic job on with that on LinkedIn, but just completely taking the piss at it. But also, obviously, I can relate working in the industry as a sales guy in the startup industry. So there's so much I can relate to at least. And yeah, I'm always having a good time when I see you in my feed, and all the more happy that you could make it.
I appreciate it. Yeah, I'm happy to be here, man.
So tell us first before we get into all of that. We break down some of your absolutely legendary posts working into the industry. Who's Jack? Where do you come from? What's your background? How did you end up doing what you're actually doing now?
So I was born in a Swiss castle in the Alps about 27 years ago. No, I'm originally, unfortunately, not. I really do wish I was. I feel like I was born nobility, but in like an upper middle class body in Connecticut. So I was born in New York City. My parents are small business owners and entrepreneurs, and were my entire life. So that's how I actually got exposed to entrepreneurship. Um, but I grew up outside the city in the woods of Connecticut, which is like the state for all those people not in the best country in the world, you motherfuckers. It's the state right above New York. And I had like a pretty simple childhood for the most part. I think what got me into entrepreneurship, I eventually found my way into tech, although I wanted to originally be a comedy writer, is I built Minecraft servers with my twin brother, and they went viral from the time I was like 15 to 17. We built these games that had millions of players, which was a lot of fun. And it taught me like how to growth hack, how to, build a product that people love, how to moderate communities of literally millions of players. And it was like, without even realizing, it was like a crash course on how to build a company, because you have no ego attached to anything when you're 16. And so you're willing to literally do anything because your ego is so small. You're like, there's no pride. You'll like post on YouTube comments to get users. You'll literally beg and grovel and plead people to pay you money. And it was just a really fun experience. So that got me into tech. And then ultimately I found my way. When that failed, I went to college. I found myself in crypto. I got involved with the first gaming cryptocurrency, raised a $53 million ICO for them, dropped out of college, moved to Belgrade, Serbia, where we had a team of 150 engineers. That was a really wild experience. And then after that, I just spent the last 7 or 8 years in the tech industry building startups for mostly failure, but raising money along the way. So I worked at a startup accelerator, left that, built another company, raised a couple $1 million for that. And then I found myself meeting a lot of founders who needed help fundraising, and they kept asking me for help fundraising. And without even kind of realizing it, one day I just found myself coaching people on how to raise capital. And that's what I do today outside of shit posting on the internet, which I'm way more popular for.
Yeah. But again, I also want to learn. I would definitely want to, we're here to pick your brain also on how you actually work with startups, with founders. I think it'll be very fascinating. Curious, so when you say, so you're from, the East Coast, have you ever entertained the idea of actually going to the Valley, or have you
No,
been there? Or you because
I've
you've
been,
always stayed?
I've been there. I would literally never move to San Francisco in a million years, despite I have many friends there who would beg me to and say that it's not my kind of culture. I'm like an East Coaster, a New Yorker at heart. It's more, the nice thing about New York is people will tell you to go fuck yourself to your face. And a lot of people would think that's a bad thing, but it's authentic. They mean it, They don't like you. They're like, I don't want to hang out with you. Leave me alone. Whereas like I find West Coast to be more of it's more passive aggressive. They're like, yeah, he's just not for me. They really want to kill you, but it's just like kind of like this fakeness energy that I'm not a big fan of. And then, quite frankly, for San Francisco, like I think I love to visit. I think it's a really cool city. The geography is really cool. There's a lot of smart, talented people there, obviously, but it's also just a lot of blowhards. And I like to have friends that are not in tech and have no idea what this industry is. And I find that a little bit more challenging in places like San Francisco, unless you're trying to just hang out with like a bunch of trans artists in like, the slums. So.
All right. Yeah. No, I hear. And I mean, after all, you do still have a pretty big scene out there in New York. After all, it's still a very relevant place for, obviously, for finance, but you do have a big scene out there. So it's not like there's nothing to do for you, right?
Yeah, no, it's like I would say New York is about a third of the size of San Francisco's tech scene at this point. Not in terms of engineering talent. There's a couple things that San Francisco has way, 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 way better than New York. But in terms of like capital and number of startups, New York is like a really close second in a bunch of categories. And I think most tech people kind of agree that New York's a more fun place to live. There's been a huge exodus out of San Francisco to New York, and it's mainly because like the quality of life and like New York is just probably a more interesting place to live because it's like one of literally the greatest places on earth. It's also madness, but if you like cities, it's a really cool place to be.
Yeah, no doubt. What about Austin though? Because obviously a lot of people have now moved their
Oh,
companies for
fuck
different purposes.
Austin.
Fuck Austin.
Yeah, no, I mean, listen, I'm sure it's cool. It's just like everyone who's like, that's the new tech hub. It's really just a tax haven. It's people that don't want to pay taxes, go to Austin, Texas. There's like a million people there, which is basically nothing. Most people are farmers and like, artsy fartsy types. I think there's going to be like, there is a decent scene there. There's money there, but I don't think it will ever be that popular of a place. It'll never be what people think it is. And same with Miami. Like, it just doesn't have like the raw engineering talent and like the actual tech infrastructure. Maybe I'm wrong, But I think the main appeal, like everyone kind of is like, oh, Austin, I moved there for the vibe or what, yada, 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 whatever. It's really taxes, which is great. You know, you save 12% on taxes a year if you move there, which is huge. But like everyone who's like trying to pretend like it's like the next big thing, I'm like, okay, it's not. It's like tiny. It's still tiny in comparison.
Okay, got it. Yeah, I've never been. I've only been in New York and San Francisco, obviously. Yeah, so then let's actually break it down, because again, I think there's a lot of folks who, even though they work in tech and have been working in tech for startups for a long time, they know what a VC is most likely, but then when it gets to the very nitty gritty things of how that word actually works, I think a lot of us have never been exposed to it. Unless you're a founder, you're never really dealing with VCs. I mean, if you get lucky, indirectly maybe, if they kind of give you some advice how to run your sales operations or whatever, like, I've had some of those experiences. But I think apart from that, it feels like a very removed thing. And so I think it'll be very interesting for a lot of folks just to get a flavor of kind of what's it like inside. So like, why don't you break that down for us?
Okay, so how venture capital works is sovereign wealth funds, pension funds, Russian oligarchs, and blood money need to launder money. And so they give it to a bunch of people that promise to invest in high growth tech companies and potentially return 100x on investments. And so they invest in a couple dudes who they think can find and invest in competitive tech companies. And then the VCs themselves take other people's money and invest it in startups like your company or my company in the past. And they basically, out of every 100 investments, they're hoping for 1 to 3 winners, meaning 1 to 3 companies that become worth $1 billion or more, and ideally way more. And that basically, those couple winners will pay for all of their investments that fail. So if they have 100 investments, 95 of them could go to zero and 5 of them could win. And that would pay for the entire fund. And that fund could return like 30% a year over the entire life cycle of a fund. And most funds have a lifespan of it'll probably take 10 years for them to make money, meaning that it'll take 10 years for the companies they invest in to eventually be profitable. So they make these investments today with the hope that in 10 years, over the course of those 10 years, that fund that they raised from those Russian oligarchs and that blood money will eventually be worth, it started at $100 million. In 10 years, it'll be worth, $300 million, $1 billion, or $2 billion. And so that's like the fundamentals of how venture capital works. I don't know if that's what you were looking for, but that's it. And I'm obviously joking about the Russian oligarchs, although kind of not joking as well, in terms of like being the investors in these funds. But that's the raw dynamics of venture capital. There's nothing inherently wrong with that. Like, I make a lot of jokes about venture capital. I have a bunch of venture capital friends of mine that are friends of mine. I know a bunch of people in venture capital. I worked at a startup accelerator before, and there's a lot of great, smart people that work in VC. But there's also a lot of idiots that work in VC. I think there's idiots that work in every industry. The main difference of why venture capital is so frustrating for people is because their power. These people have perceived power because they have money that a lot of people want. And so the money goes to their head, even though it's not their money. And so they're like, I'm giving people money, so I'm special. And the other people on the flip side think they're special because they can give them money. And so it creates this weird dynamic of like a lot of people who have overinflated egos and think they're really smart, even though they're not. And like being a VC is like not a particularly challenging job. And like if you and I became VCs, our investment returns would probably be average compared to the entire industry, even though we could be like smoking crack all day long. It's like really not that hard of a job, in my opinion. But to be really good, you do have to be really good. And so then like to be Mark Andreessen, you do have to be a really, who's the founder of A16Z, you do have to be a really, really good investor, really understand tech companies and be able to predict the future. But like the average is not very challenging, which is fine. The average for most industries isn't really challenging. It's just that like you then have these people that are constantly rejecting people, constantly saying no, and everyone wants their money, and it creates this like a dynamic where people get really kind of jaded by these people that are investors, and it creates. And then there's a lot of people who are just like genuine assholes and are obnoxious goons who run VC funds. So that's my like short diatribe on venture capital and how it works.
The most surprising thing is actually when you say that it is not that hard. I mean, obviously it's a matter of perspective, I suppose. But I feel like my idea was always that you have to be decently good at math. A lot of them are MBAs. They have a good okay. See, like that. I think that's kind of the perception that people have when they think about investors, especially VCs, not angels, but like especially VCs, that they're actually pretty smart people.
I think I would condition this and say at later stages where there's later stages of capital, meaning like Series A, B, C, and beyond. These companies are actually making money, and you're looking at their EBITDA, their books, seeing how much revenue they're making, and it becomes a little bit more to your point, like getting into the numbers. The problem is, however, at the pre-seed, seed stage, early fundraising stage, which is where the majority of fundraising rounds are made, because most companies don't even make it to Series B and beyond, right? Mm. At that stage, you're making a fly-by-night investment, typically on minimal to non-existent revenue, into a company that is run by oftentimes 23-year-olds who just graduated from Stanford. So the idea that you're doing a lot of math and predicting things out, sometimes, but the reality is most investors, like VC has gotten so large, disproportionately to where it was, say 10 to 20 years ago, that there's a lot of new fund managers out there and a lot of new funds. And what these funds are doing is they're really, really scared of making their own investments. Like actually deciding like Dennis's company is really unique and I'm going to be the first person to invest in it is really hard and scary. And it's really risky for new fund managers. So instead, what they do is they see Dennis just got a check from A16Z or is talking to A16Z and Sequoia and all the other biggest, more successful VC funds in the world. I want to invest there too. So they become funds that focus mainly on they focus on FOMO, meaning is everyone else in the VC industry that's a big player looking at this company and considering it? And if they invest, then we'll just follow on. And so rather than having to make our own decisions and bets and find things, we're just going to follow on to all the other most successful funds that we know and all the other people we know that are good investors. Like I always like to joke, there's like 8 VCs with original thoughts, and then everyone else like reads their blog and tweets. Like the second Andrew Chen or Paul Graham says, community is the future, the next week you're going to be someone is going to write a long thread that works at like Benchmark and it's like community is the future, and it's like that's Paul Graham's blog with like different words, or now you translate it into German and you're like, no, I'm really into community all of a sudden. It's like, no, you're not. A16Z just announced a community fund and now your fund's into community. And so it's just it's not that there aren't smart people, it's that the reality with how venture capital works is that for the most part, it doesn't incentivize people to be really smart. It incentivizes people to know how to play politics, because you can like kiss people's asses, know how to like understand social dynamics in a competitive fund, curry favor, get promotions from analyst to associate to principal to whatever. And then you're really just following on most of the time to other people who've made decisions for you. And so that doesn't really incentivize like people that are really intelligent. It incentivizes people that are good at playing politics and are good at like playing the game of VC. It doesn't necessarily incentivize people to be like free thinkers and like contrarians and people who have like really unique perspectives most of the time. To be a big winner, it does incentivize you to be that. But to be an average VC, it doesn't. And like a regression to the mean, everyone is just like, a lot of people in the industry are like talk a really big game, but are like, okay, you could just like throw a dart at a dartboard and have just as much success as you, and you're acting like you're a big shot.
Would you say that the way that you got into the game was comparably unconventional? Because it's what I mean, I don't know if that's just a stereotype how most people get into VC, but you talk about your background. Would you say that that's not maybe the most common way to actually becoming a VC, or is that really just a skewed perception that people have, and it's just kind of random? You come from all sorts of places.
Yeah, I mean, well, let's be clear. I don't even have a real VC fund. I have a fake VC fund called Jabroni Capital. So I write shitposts. I have worked in VC at a startup accelerator, but not for very long. And I'd say on average, the people who work in VC, most of the time, there's two camps. It's for the most part two groups. It's like the operator type, so someone who like works at Uber, gets an MBA, and then gets hired as an associate at a VC fund, or they're the founder angel investor type. So it's like you're a founder, you exit a company, you angel invest in other companies, and then A16Z hires you to be a partner because you have like really great operating experience building it. You were a startup founder, exited a company, made money, made your own angel investment portfolio. Now you work at A16Z. Those are by far the two most common routes. And so I probably would fall closer into the second one, although I'm not very successful. Most of everything I've ever done has failed. So that's also a track for VC as well. Is you fail a lot, and then they're like, well, you have a lot of experience failing, so come join the team. But to be clear, I don't have a VC fund, and I have literally no interest in being a venture capitalist. Like objectively not.
Got it. So tell us then how you talk a little bit about the politics. How is actually a fund like that actually structured? Because I think it's also interesting. I forgot the name of the book that I started reading the other day on Audible. It's probably like that kind of I think the Bible, if you want to get into into funding. And it was talking also about kind of like the org chart, how one of these firms is actually organized.
Yes.
You could talk a little bit about that because you already mentioned some of the titles there. But I think again, like if you have never been exposed to that, it's kind of complicated almost.
Yes. So okay, so it works kind of like a company. So at the very top, so there's typically a founding partner. So like say managing partner is the person who starts the fund, and then they have a string of other key decision makers who are at the top, which are general partners. Sometimes there's one key decision maker who's like the real head honcho, and then other times there's a group of head honchos. So it's more of like an oligarchy or it's a dictatorship to some degree. So the general partners and managing partners are the people who run the fund. They go out and convince other people that work at pension funds, family offices, whatever, to give them money to invest. So they raise money themselves. VCs raise other people's money to invest in startups. So these general partners at the top run the fund. And then the people below them, generally speaking, if it's a large fund, there will be another layer of partners where the partners are the ones that make investment decisions, lead the companies, manage the actual relationships with the founders, and they're decision makers in investment. So there will be general partners, and the step below partners is principals. Principals are people that have like some decision-making power. You've been in a firm for like 5 to 7 years. You sit on the boards of a bunch of companies. You're almost a partner, but you're not quite there. You'll probably make partner if you do a good job in the next couple of years, and then you'll be a decision maker after that, but you are kind of a decision maker at principal level. Below that is senior associate, which is just you source deals and write up investment memos for partners. You're on your way to becoming principal. You can get paid a lot. These people, their job is sourcing deals and meeting founders, and they'll often be the first people that take calls for VCs and then like gatekeep companies getting to partners. Below that is associate, which is just a less experienced and less paid senior associate, but same sort of job function, sourcing deals, gatekeeping before conversations happen with principals and partners. And the rung at the very bottom is analysts, which will sometimes also be gatekeepers. But for the most part, analysts are people that are doing research on the industry. They're doing due diligence on like, does this company like make sense? Is it like a good investment? Yada, yada, yada. And they basically like research bitches at the very bottom. So that's like the typical hierarchy of a fund. And all of this runs off of the backbone of management fees and carry. So how these people make money is, say those managing partners raise $1 billion, they charge their LPs, meaning the people that gave them the money, family offices, pension funds, etc. They charge them a 2% management fee. So every year they pay themselves 2% of the $1 billion to run the fund. And then in addition, if they make successful investments, they also get a 20% carry. This is generally 2 and 20 is the normal fee structure. And 20% carry means if those partners invest in a startup that goes up 100x, they get 20% of the return on that investment. Mm-hmm. And so that's how VCs become super fucking rich. If they make really good investments, you invest in Airbnb for 300, take Gary Tan. He invested in Coinbase for $300,000. Coinbase IPO'd for fucking $8 billion or whatever it was. He turned $300,000 at seed stage probably into $3 billion of capital, and he gets 20% of that return.
Yeah, incredible. I was just looking at the Sequoia example the other day of WhatsApp. I think that's another outlier, right? But then again, I guess you would also say like these are really like outliers. That's not the norm, right? I mean, that's I think it's probably the wrong idea people have when they start getting into this, where they think, oh, I'm just gonna discover the next Facebook. And
I think that's the toxic culture in tech is that we've convinced a generation of people that the way people get rich is by starting tech companies, and that's not how people get rich. 99% of people who have millions of dollars in the States own like, plumbing businesses, laundromats, HVAC businesses, things that are boring but make a couple $1,000,000 a year and have good cash flow. And now everyone has this idea that the way to become rich is to start WhatsApp, which the chances of that happening are like 1 in a billion. And so everyone's shooting for 1 in a billion instead of trying to, make $10 million the good old fashioned way. And I think that's that's the thing I have the most, that it hurts me the most when I listen to founders, because they're like, I'm gonna make it. I'm gonna be really big, and I'm like, you make $82,000 a year right now. You have for the last 8 years. Your company is likely going to fail, and you're 32. Like, this is not a great outcome. If you just worked as an employee, invested in stocks, and like bought a condo and Airbnb'd it, you'd have way more money right now. And I think that's the toxic culture that's in tech, is not understanding that what it takes to actually succeed and build a tech company that gets acquired for a lot of money is so unlikely that for most people, it just doesn't make sense. Even for me, like, I have no interest in doing that ever again, because I can cash flow more being a meme poster online than I could as a tech CEO.
Yeah, I want to get into that a little later, but I think again, it's an important reminder what you said, like the bias that there is. I mean, if you look at the cemetery, right, of startups that don't make it, like you said, even to round B, C, D, I mean, or IPO for that matter. One of the posts that because you were just talking about associate, you made a post the other day about what you're looking for in candidates, and you were saying ability to ask founders questions that make them want to jump off of a cliff. So one of the things that I'm curious about is how did you get into this where you started, when you say like, making these memes, posting on LinkedIn, and really just, you kind of hinted at it already, because you said like the authenticity piece is something that's really, really important for you. And in a way, I guess you also want to show people what it's really like, and you use your humor very well to do that. But yeah, how did you start doing that? You said that you wanted to be a comedic writer. You always had that talent anyway, and so you kind of just combined and just started getting incredible traction with that on LinkedIn.
Yeah, so it was almost a year ago now, exactly. I was writing a serious LinkedIn post, which anyone who's written a serious LinkedIn post knows is that's like the saddest thing you can do with your time. Like, you feel like such a loser because you are. But not that it's not, you shouldn't do it, because making money is cool. So if it like makes you money and gets you success, that's the reason we suffer through pain. But it's like a really grovelly kind of like gross form of content. And so I was doing this for my business, my consulting practice. And so one day I just, I met with a friend, and the consulting practice was not going very well. Like, we were having a down month. Like, I hadn't made money in like a month, and I was like, I'm going to have to sell more Bitcoin or Dogecoin or whatever. And like, that's not a great feeling. And my buddy looks at me and he goes, something really has to change. And I was like, yeah, I know. And I was just like, it was like a tough moment, like sitting in a WeWork I did not pay for, looking at my buddy being like, yeah, what am I going to do now? Because I don't want to be a startup founder. I don't want to work for anyone. And so I woke up the next day, I'm writing this serious LinkedIn post, and I just delete it entirely. And in 10 minutes, I write, I'm excited to announce I have a fund. I'm launching a fund called Jabroni Capital. And then I just made a couple jokes under that. Like, we back founders at the earliest stage, but not you because you're too early. And then I just said a bunch of silly things that, like, just things I would say to my friends if joking about VC. I posted it, and it immediately went viral and got a couple thousand likes. And I was like, no shit, like, that works? Really? Just saying, like, making satirical jokes about VC makes me go viral. And I got like 300 DMs from people that day. And so I decided, just like, what if I just kept doing this? And then I just decided to launch a newsletter immediately on top of it. And I was like, I don't even know if I want to start a newsletter. It sounds like a lot of work. But I was like, a big thing I've always done in life is when momentum comes your way, you must run full speed at momentum. It's totally fine to be a trapdoor spider. Trapdoor spider just lies in waits for a long time. But the second a bug crawls above on top of it, it strikes and goes all in on that moment. And that's kind of what Jabroni Capital was. Like that thing went viral, and I was like, I guess this is what I'm going to do now. And then it became really fun, and I kind of got addicted to it over the next couple months. And I just kept posting, kept getting really great traction. And I was like, so this isn't just like a one-time viral post. I can keep doing this and keep figuring out how to like get better and make better content. And now I've done that for almost a year now. But that was the origin of how I got started. It was just like I'd been in tech. I'd obviously made these jokes in private to a lot of friends, but I'd never posted them publicly. And so I just started posting them publicly, and I was like, oh, people like this. I'll just keep doing it.
And I think it's probably also because it's kind of relatable and it's so refreshing to see on LinkedIn, because you say like, because you realize that nobody on LinkedIn really acts like that in private the way they pretend to be on that platform, right? Like all serious, all PC, and yet I don't know what happened that platform has this sort of still is not there where people feel comfortable to do that. I mean, it's like you're always walking on eggshells. When you look at the comment sections, people are very scared to challenge each other, and it makes it kind of super boring, because I think there's so many cool people out there still. And so I think like you're probably also inspiring a lot of other people to not take themselves too seriously, because obviously you are doing serious business. You're very good at what you're doing.
Yeah, well, I used to be really negative on LinkedIn, where I was like, it is so inauthentic, which it is, and no one like says their actual opinion, argues, etc., blah blah blah. And then I started an Instagram, and the amount of vitriol and fighting that happens in the comments section on the Jabroni Capital Instagram page, which I don't even manage. I pay someone to manage for me, so I don't even have to look at it. But like occasionally I'll go on and like see a comment thread of just people be like, oh, fuck you, you idiot. Just the meanest things you could say about someone off of like a stupid meme post where we're joking. And then they're like calling us idiots. Everyone's a fucking moron. And I'm like, actually LinkedIn's kind of nice. I was like, it's because at least you're not getting all of like the just people's like negative demons being thrown at you, but it is very inauthentic. And so my competitive advantage, I feel like on LinkedIn is to say silly things, to be lighthearted, but to make myself the butt of most jokes. And so like when people respond and they're like angry at me, I always am like, I act like an even bigger loser. And so I just like I'm like, yeah, my ex-girlfriend dumped me because she said that or whatever. And then I'll just act like a big bozo, and people are like, okay, so he's not like gloating, and he's the biggest idiot on here. And I think that like that sort of self-deprecation plus making jokes that people relate to, that's been kind of the sweet spot combo. I think you need to do both. Otherwise, people just think you're like egotistical and a dick.
Yeah. No, for sure. Or that you could be trolling. But then you also, what I realized, like you just said, there's some people in your comments also who take this actually very seriously.
Oh yeah.
What you say, you've made jokes about, kind of, putting together the Avengers of people that you want to have and all these, and you're just having SBF and those guys in there. Like some people take it very seriously and really moralize you.
Oh yeah, a lot of people moralize me, and especially I'll make jokes about it's. So you notice a lot of interesting things. Like I joked about there is people on LinkedIn that are putting hashtag desperate. You know how you can do like hashtag open to work on LinkedIn? You can now put hashtag anything on your profile picture on LinkedIn. So you could put like hashtag desperate. So like a Wall Street Journal published an article that said people are putting hashtag desperate because they're so desperate for work. So I posted that I was going to offer all of these people that were desperate unpaid internships, because what they really needed is work experience. And paying rent is important, but work experience is more important. And then just like, obviously people were like, you're a terrible person. But like, my rule is to only respond in jest. So I always just respond jokingly. But a lot of people they get so mad and so upset. And there's really two camps of people. It's like, once they realize you're joking, I'd say 50% of people are like, oh, you got me. Ha ha ha. And then like they actually like the content going forward and engage. The other half block me, start posting about how terrible of a person I am, and do that whole thing, which I also get. It's just it's tough out there. People's brains are being melted by social media, so they can't handle it. That's fine.
Yeah. Well, anyway, yeah, it's maybe not for everyone, but I'm having always a great time. So, what I'm curious about, on a more serious note, how do you actually work with founders? And again, basically picking up on the talk that you gave yesterday, because I think it's super interesting. Like again, right now, I became part of a startup. I'm heading up the sales, indirectly helping with the fundraising, obviously, but not leading it. But I'd be very curious, like how you actually work with founders to get them ready. Basically what you talked about yesterday, creating that urgency, and in particular things, obviously, common pitfalls that people make, especially if it's like a first time thing for them, that they're not aware of. When you talk about, even though you said it's all a bit of a game, it's all the politics, but you still got to know how to play.
Yeah. So my business is kind of simple. I work with founders on a coaching basis that are trying to raise money. So most of my clients are people that are raising somewhere between $1 million to $10 million. So it's mainly early stage up to Series A. And what I work on is two things. So like the first thing is like you'll hear this a bunch, like how do you craft a narrative and tell a story that gets investors excited? Most people don't fundraise using storytelling techniques. They just use classic McKinsey PowerPoint presentation. This is the problem, this is the solution, yada, yada, yada. It's not very compelling. It doesn't get people to feel like an emotion towards your business. So I work with people on narrative. But I'd say the thing that I'm the most unique at and what I try and focus on is how to run what I call a process. And so most founders, when they approach fundraising, they just start fundraising one day. They're like, I need money, time to go talk to VCs. And they have like a handful of conversations every week for a year. And the fundraise takes forever. Maybe it never happens. And it's like this long, drawn out, terrible process. Whereas people in Silicon Valley, when they want to raise capital, they will only raise capital when they can get like 100 meetings on their calendar for sure. So they go spend a couple months preparing, getting everyone that they've ever met to agree to make introductions. They find another 30, 40 people that can agree to make introductions that are venture-backed founders, angel investors, VCs, and then they launch their fundraise like a product launch, and they get all of their investor meetings in 2 to 4 weeks. So they try and have as many investor meetings in a month rather than having 100 investor meetings over a year. They have 100 investor meetings in 4 weeks. And what that does is it just creates a natural competitive dynamic among investors. They know you're talking to a lot of people. You know you're talking to a lot of people, so you're more confident. You're saying more ballsy, crazy things, and it creates like momentum and inertia. When all these people know that they have to make a yes or no decision right now, they're more likely to give you a yes or no right now, right? If they know you're only talking to 5 of their investors, they're like, well, let's wait. Because the 5 of their investors is probably not going to give them money. Say there's a 1% chance any VC will give you money. The VC's like, okay, they're talking to 5 people, 5% chance they'll get a term sheet. Let's wait. We don't have to. We don't have to say yes right now. They're probably not going to get a term sheet. But if you're talking to 60 investors, they're like, okay, there's a really high chance they're going to get a term sheet. So we have to make a decision right now, yes or no, if we want to talk, if we want to move forward with an investment, or at least move forward and get them another meeting. So I work with founders to help them launch that process and like help them figure out like, how do I actually get 100 meetings in a short period of time? And so that's what I work with people on. Going back to your other question of like, what do I think are the most common pitfalls in that process? The number one is most founders that come to me, they only think about talking to VCs. They're like, I just need to talk to VCs to raise my round. If I'm raising capital, I don't go to VCs first, and I don't talk to VCs for oftentimes like a month or two. I go directly to venture-backed founders. Getting on the phone with venture-backed founders is way easier. They understand the fundraising process. And if they're in your space, like if you are a health tech founder and you go talk to a health tech founder that raised $3 million last year, that health tech founder you're talking to will oftentimes have 10 to 25 investors on their cap table who they send monthly updates to, who they can introduce you to. So if you win that one person over, you might be able to get like 5 introductions to investors in their network or that literally are on their cap table. And that process of getting a conversation with a founder and getting them to agree to make introductions is way easier than going directly to a VC and getting that VC to agree to talk with you. So what I always recommend to people is before you go out and just start talking with investors right now, go talk to venture-backed founders who can tell you bluntly, your business sucks, your pitch sucks, you don't have what it takes, or, hey man, I think you have what it takes. I'm willing to make introductions. And you tell them, can you make introductions for me in a month when I'm going out for my raise? And they're probably going to say, yeah, for sure. Just let me know. So that's like the main pitfall I think most people run into.
I want to go back to the first part because it's super fascinating. So it's almost sounding like it's like you're running this like a political campaign where you say like someone who's never done this before, they just kind of stumble into it and it's very inefficient. It's very frustrating. You don't really have momentum. You don't you don't make any leaps. But what you are saying is really you are using, it's almost like kind of compounds. You have the levers, and it's a lot of, vouching and having your name out there. And then what you said at the beginning, the FOMO, right?
Mm-hmm.
That you create. It's almost like this artificial thing that
Yeah.
then that happens. But still, I would claim you still got to have something that is solid enough that the first person is willing to take you to person B and C and D and kind of spread the word for you.
Absolutely. I mean, the nuance here is that most people that go out to raise money have dog shit ideas that don't deserve money, and they think they're great. And that's like, if you don't have something that is venture backable, your life becomes way harder. You can still raise money. Many people do, as you and I both know. We come across a startup that's like decentralized Beanie Baby trading company, and we're like, how the fuck did they raise $80 million? But they did, because there's a lot of dumb money out there, and they throw money at the wall. But that's very rare. Most companies that get funding are at least in industries that VCs are looking to invest in, right? So like at any given time, there are hot funding sectors in venture capital. Right now, direct to consumer products, dead. Ed tech, not going super hot. There's a bunch of like industries that are just not hot. VCs are like sick of them. They tried investing in them 5 or 10 years ago. There was only 1 or 2 winners. They lost a lot of money. So now they're not even considering investing in those companies, right? And so a lot of founders come to me. They're like, why does no one want to back my e-commerce brand? And I'm like, bro, remember fucking 5 years ago when a billion e-commerce brands popped up and raised money and they all failed? And they're like, oh yeah. I'm like, so now you have to convince people you're not going to fail, even though everyone 3 years ago did. And the money shifts and it's now getting focused in other areas. So I think understanding that dynamic of where money's going and what VCs are looking to invest in right now, it's really doable. You can keep track. It's actually not nearly as hard as people think to keep track of that trends. It's a matter of like subscribing to the right newsletters, being on tech Twitter, as horrible of a place that is, like paying attention to what VCs are tweeting about, investing in, following Crunchbase reports, open, Carter docs where they report the kinds of funding stats that are going out. And if you know what VCs are investing in, you can position your company to look like one of those companies, right? You see all these other companies that are getting investing in the last month. You're like, how do I position myself to like kind of look like them? We still do what we do, but how do we like position ourselves to do something similar or be in the same vein? And when you do that, you have a much higher rate of raising capital because that's what's hot right now. That's where money's being thrown. And so that's the other nuance is like have a business that's venture backable and have something that VCs are actually looking to invest in right now, or at least position your company to be something that VCs are looking to invest in right now, or at least know that information. Even if you're going to build the e-commerce company anyway, you should at least know like how dead the market is. So when you start pitches, you can be like, I know shit's dead, but we've got a real winner on our hands. And you can like get ahead of the problem everyone's feeling.
What are some of the things right now that VCs are actively looking for when you say ad tech is sort of dead e-commerce? What are some of the newer things? I mean, you made a post the other day about basically, I think you said like making open AI calls or something like that.
Yeah.
So, but like, what are the things right now? Because I feel like everything that is AI, sort of, give that sticker on there.
Yeah.
Yeah, but how do you navigate through that right now? If you want to fundraise and you want to be relevant from that perspective, like what's actually hot?
Yeah, AI is obviously hot. And things that are AI adjacent, meaning they use an AI component, are still pretty hot. I think the nuance is that people are still looking for real businesses there. So if you have no revenue and you're not like a serial founder who really has tons of amazing contacts in the industry, you're going to struggle. Even if you have an AI company, it's not magic. You can't just say AI, raise money. Other things that I'm seeing kind of become hotter, like I think crypto will come back. It's not hot yet, but it's going to come back soon as like prices go back up. And that will be a nightmare. Like we're all going to like want to slam our heads into a table because that'll just be like, again, the obnoxious, stupid crypto boom. But immediately right now, I'd say like there's a certain number of fintech deals that are getting done. So like financial fintech has still remaining pretty strong. we're seeing hardware come back more, where people like deep tech hardware is getting people excited again, because if you have a really good product, you can build a moat around that and it's like really unique, opposed to like B2B SaaS companies that, you know, they had like a subscription tool for something the last, 10 years. And that's becoming a really competitive space, a really overly competitive and oversaturated space where, those companies had way too high inflated revenue multiples and they're just not succeeding as much. So I'd say like fintech, deep tech, AI, those are like the three areas that I think are the most like easy to raise for right now, relatively. It's always hard, but relatively.
Interesting with the hardware, though. Do you think also it's because it's a little bit influenced by the NVIDIA
That's
case?
exactly right.
Store?
It's exactly right. So when I say it's relatively easier for, I should also say that it's still not easy. Hardware is always harder to build and raise money for because you need way more money. It's becoming way hotter than it's historically been. Like there's more people that are like back into that hype train of like, yeah, he's got like a cool fucking hardware product. He's going to beat NVIDIA or whatever. And they're seeing the success of NVIDIA. So it's getting people attracted again. 100, great point.
Another question that I had was that I watched a podcast the other day with some of the founders of Palantir, and someone was interviewing Alex Karp. Very cool podcast. One of the learnings that he had was obviously they're in a very specific industry, but he was saying, reflecting on his fundraising process, he was saying in hindsight, we should have been nicer to the government people, and we should have been more assholes to the investors. Obviously, he's Alex Karp, right? He's a very smart guy. But what do you make out of that? Assuming that at least you are a smart guy and you have something good going for yourself.
Yeah, I think the big thing is like being mean to regulators ain't going to get you very far. Uncle Sam can stop all progress. VCs can't really stop you. If you are successful, they don't really have a lot of pull. So I think the nuance there is that one, like being nice to the government and like getting buddy with them, you'll win bigger contracts. Look at Microsoft, look at NVIDIA. They win contracts and get $20 billion instantly from the government, Boeing, whatever. The government is, I have a friend of mine who has a software contracting company and he makes, $15,000 an hour software contracting for the government, multi-$100 million business. Because you win a contract with the government and it's a $200 million contract, you can have, $100 million company off of one deal. And you're the like sole provider to like the health department or something. And so it's great money. It's very secure. And those contracts are huge, especially for a company like Palantir that like it would sell ideally to the government. And then the flip side is like, why be dicks to VCs? Because like you don't really get much being really nice to VCs. If you have a business that makes a lot of money, VCs are always going to want to invest. They throw their ego away very quickly to invest in the best founders. And if you are kind of a dick, you look like a winner because they're like, they don't want my affection. It's the same thing of being like why negging works on some women, which is like a bad thing. Don't neg, but don't be a dick. But like why it kind of works is they're like, why don't they want my attention? Why is this guy mean to me? There's something about that I kind of like because you're trying to win over their attention. And that same dynamic works in VC. Fundraising is a lot like dating. Like the same tactics that apply to dating apply to venture raising money. And I imagine that's kind of why Alex Karp is saying that. He's like, you don't even really need to be nice to them because like they'll give you money if you're winning anyway. And if you're a dick to them, they might even want to give you more money because they're like, wow, he's a real winner. He's going to Steve Jobs his way to success.
Yeah, no doubt about that. The other thing that I'm seeing a lot these days on LinkedIn is actually a lot of people talking about bootstrapping. And I'd be curious to get your thoughts on that. Obviously, there's one guy that's become very popular, a guy called Adam Robinson. He's very, I don't know if you're familiar with him. He must have 100,000 followers or something at this point.
Wow.
And I think they grew to like 23 million ARR or something, bootstrapped in like a couple of years. E-commerce actually.
Wow.
Anyway, but so, I hear there's more and more bootstrap founders popping up here and there. So I'm curious about your thoughts here. If you were, advising a founder, would you say that taking external money from angels and then later VCs is always the right path? I guess maybe are you also biased to some degree, or would you actually say, well, if there's certain indicators, and bootstrapping is really the way forward, and maybe you you can become one kind of what's the one famous example? The monkey, what's the name?
MailChimp.
MailChimp, yeah, sorry.
Yeah.
I mean, obviously that's a crazy example, but what are your thoughts on the bootstrapping thing?
If you can bootstrap, why would you raise money? Like I tell people all the time, I can tell people not to raise money a lot. Like it happens to me at least once a week where I talk to someone. I'm like, why would you want to raise money? You're out of your fucking mind. I think the reality is one of my richest friends sold a company for $8 million. It was a SaaS tool. He built it to $2 million in revenue and he sold it for $8 million. He received $8 million because he had no outside capital. I know people who sold their company for $200 million and received $500K because they sold so much of the company. They raised at such a high valuation and it's selling the company for $200 million, just like they couldn't make the math work. They raised too much and they didn't have enough revenue to justify raising at a high enough valuation that they got peanuts on the dollar for their equity stake in the company. And so I think the nuance here is that if you can build a business that makes $10 million a year with no outside capital, you should do that. You'll statistically be way richer if you sell that company than if you raise money. If I think the time to take venture capital is ideally when you have a lot of leverage. When you have something that's already growing really well, that already makes a lot of money, the margins are quite good, and you're using venture capital money like lighter fluid on a fire. It will burn way brighter and grow way faster and go electrically big if you take that money. But regardless, the fire will burn and grow even if you don't. And that's really how venture capital should be used in an ideal sense. The only other exceptions I bake there is if you're building something that requires venture capital to be built, like hardware, really expensive software that's like is groundbreaking, like OpenAI. Like you needed $1 billion pre-revenue to build that, but that's very rare and almost never the case. If you can bootstrap, you should. You'll theoretically be way richer. It also, in my opinion, you have the right incentives aligned. Raising venture capital makes people lazy. They use money to solve problems rather than having to solve problems using value and scrappiness. Whenever I'm at my back is against a wall and I have to make money, I make money. But if you have $4 million in a bank account, you don't have to make money. You just don't. Mm. And that dynamic, like my mom always says, necessity is the mother of invention, or she always used the crop excision or whatever the stupid formal version of that is because she's a nerd. But the point is, people that have to do things always perform better. My favorite story on this is, the American space shuttle, like the rock, like the thing that it's like a plane that flies into space, the white famous rocket that flies into space. America built that for I don't even know how many billions of dollars. Russia wanted to build the same, but Russia had no goddamn money. And so they had to build their own space shuttle with 1/50th the amount of money. They built a better space shuttle. They had better features. It was for 1/50th the money because they got a bunch of smart people in the room and they're like, you're going to get $8. You have to build a space shuttle. And they're like, oh, fuck. How are we going to build a space shuttle with $8? And they forced them to innovate and force them to do things that were really, really out of the box and smart. But if they had the same money as NASA, it probably wouldn't have gone as well. I also probably wouldn't want to fly in the Russian one, just to be clear. I would still prefer to be on the American one.
One of the things that I've also realized is that I feel what you just mentioned, I think when I say back in the day, a couple of years ago, I think people took a lot of pride in how much money they raised. It was a lot, as a founder, as a company. And I remember at also companies that I knew where when people talk about hypergrowth, they talked about that they've raised capital and then that they grew in headcount. But they never really meant it in the sense they actually grew in revenue. Yeah, I think that was sort of we'll get there eventually. And I think now, again, at least for what I'm picking up from LinkedIn also, is there's a lot more pride on actually making revenue, maybe even profit at one point, but definitely making revenue and taking pride in that. Is that also how you perceive it, how the industry, I guess also because of the pandemic, things have kind of been forced in that direction a little bit?
Yeah, everything just ebbs and flows. We'll be back to pre-rev. We'll go back. It might take 10 years to go back to the silliness of like head counts and money raised. My belief is that everything in this world is just like a constant ebb and flow and overcorrection. Like political correctness, for instance, was an overcorrection for people being like racist. That was an overcorrection. Everything overcorrects. So like we're going through an overcorrection, or I should say a correction, because I think we were in an overcorrection of like the overcorrection was like head counts and money raised actually mattered, which it didn't. So we're getting back to like equilibrium, which is having revenue is the point of having a business. My parents, for instance, hate the word founder. They're like, because it doesn't even apply you're a business owner. It's like you don't have a business. You founded a thing that does not make money.
That's a good point. I think someone once made a post about it on Medium. He said like you basically have to earn the term that you're an entrepreneur. Like if you're not making money, you're not an entrepreneur.
No. And so now I just I think the trend is good. It makes me happy to see people actually focus on making money and getting back to revenue. I'm sure we'll get back to the craziness we were at, but I do think that's the trend, and it's a good thing. Obviously, I've never really given a fuck if someone has raised a lot of money. I'm like, well, are they rich? It's like, well, no. Like, okay, whatever. I know plumbers that are rich. That's cool.
Yeah. No, definitely. One of the things I was definitely going to pick your brain on, by the way, is if three, I guess, at least three phrases or words that people can use to kind of at least act like they have a bit of a plan about the whole VC, almost bullshit bingo. Are there like any specific phrases, things that you can say to kind of suggest that you're, I mean, obviously there's the Patagonia vest. Someone of my old colleague calls this Patagucci.
Yeah.
But what else is there? What else do you have to say to sound like you have some kind of plan to pretend that at least?
Running a process. This is the word.
Running
a process. If you're raising money and you have any idea what you're doing, you're running a process. Everyone else is fundraising. The people that are raising money that are in the inside, they're running a fucking process. So that's the number one thing. If you're raising money, say you're running a process. You don't even have to have a process. It will definitely make people at least signal to people that you understand that there is a process to raising capital, and it isn't just like this random shit that you're doing on the back end. So that would be number one. And then in terms of like insider VC lingo, what are fun things? I think like name dropping the right kind of like, like name dropping the right kind of meme pages and like, oh, did you read so and so's blog? Or I was listening to what's the big VC disruptor I'll think of it. There's a couple of big VC podcasts that are like the more legit ones that you're
all in.
Not even the all in. That's like the kind of jokey one. There's one that's like actually legit.
Okay.
Acquired. Acquired is like the one.
That's a great one.
That's a great one, right? Like that one's more legitimate because it's like gets into like how these things actually work and how they made money. So like, I was listening. You remember the Acquired podcast? You like talk in the like, oh, you remember that one? Like we all obviously both listen to it. And so you just like, it's things like that where you just like, you talk like you're in the culture, that you're a part of it. You're watching the same people, you're playing the same game. And so it's that kind of thing where you like, it's the lingo. That's the kind of stuff that's more important. It's like, oh, did you see that tweet from Chris Backey? And they're like, oh yeah, I love that one. That was really funny. And be like, oh, what do you think about like fucking, Jack Dorsey telling Chris Backey he's a joke? And you're like, that was real fun. I like that a lot. That was great. And it's like knowing those insider players and name dropping things like that, I think is probably the best way to be on the inside track.
Oh, it sounds good. I mean, that definitely it's going to equip you to survive a dinner party, cocktail party at one of those kind of events if you have to.
I guess.
How exaggerated did you actually find the week crashed? I don't know if you watched it. Speak on that note. Have you watched it on Apple Plus?
I have not, but I have read all there is to read about it.
Okay.
I'm very fascinated. So what do I think about that?
No, because I mean, obviously, in your case, you even have the Adam Neumann lookalike thing, right, on your profile. But I thought that was just sort of the ultimate negative example, kind of going back to, okay, like, do you, there's, like you said, like, there's a purpose for having investors, there's a purpose for having VCs. And of course, there's a lot of negative examples, right? And I think that's probably the ultimate one. If we have a 180 negative example of the Sequoia WhatsApp example, it's like the ultimate negative one. I remember watching this with my ex-girlfriend at the time, and I think she's not working in tech, but she was asking me, is like, wait, is that really what it's like to be in a startup and this kind of cultish founder and this narcissism and all this craziness and the parties and all this wild stuff? And I said, not on that level maybe, but like, yeah, I've seen stuff like that. I've heard stuff like that for sure.
Yeah. I think Adam Newman's a hero. I'm going to be honest. I think he is the epitome of what tech was in 2015, 2016, like that era. He was that era. He was, a guy who overpromised and underdelivered. He built a cult, and it was a perfect metaphor for how the tech industry works, because everyone, and I mean everyone, thought he was the fucking man. I knew people, big techies, who collected stickers from different WeWorks around the world. I don't know if you knew this. There were stickers that they gave out at WeWork. And they'd be like, I'm in the WeWork Singapore. I'm in the WeWork Austin or whatever. And I knew people who collected these things, VCs who collected these things. And then what I think is so poetic about this whole thing, it was a business that never made money, never had margins that ever made sense. But people were like, this is awesome. We love it. It's great. And then it crashed and they went, how dare he? And I'm like, it was an office space startup that never had made money. Like, its margins were always bad. It said it was a tech company and you agreed, and it never was. You got exactly what you asked for. You walked right into hell. And that's what I loved about that whole situation, and why I don't feel negatively towards Adam Neumann, because he just took advantage of these fucking knuckleheads. And then they complained on the way out and were like, well, he's such a bad person. I'm like, you guys gave him money. You enabled a crack addict. The crack addict walked in scratching himself, was like, man, I need some more cash. And you're like, sure thing, Adam. Here's some more money for smack. And then at the end, he ODs and you're like, what happened? It's like, you funded a crack addict. So I think he's a legend, to be honest. And like, the most unfortunate part are all the employees that got hurt, but fuck them anyway. I'm not a moralist. I'm kidding. But point being is just like, I think it's a fun story because it encapsulates everything in tech that these people like. They walked right into it, and they act like they're victims. I'm like, guys, come on.
Yeah. No, I think once you've kind of been on one of those rides, you met one of those founders, maybe not on that level, but I think that scars you, and it gives you a new perspective on this. Before we wrap up, and before we talk actually about how people can contact you and what you're going to do after, I want to pick up, if you have a few more minutes, on the cap table and how that works, because I think that again, you've touched on it before. That's obviously more, again, for me at least, it sounds like a more complex thing how that works.
Yeah.
So when you talk about equity, the participation and buying part of a company, if you could, try to break that down.
Sure.
For people that have really no idea how that works.
Yeah, the good news is cap tables are actually not as simple. They sound more complicated than they are. It's basically a spreadsheet of ownership of the company, right? So you and I start a company, Dennis. Each of us gets 50% theoretically of the existing equity. So there's 10 million shares. You get 5 million. I get 5 million. When we take on investment, more shares are created proportional to the amount that person gave us. So if they buy 10% of the company for $1 million, that's a $10 million valuation. More shares will be made for that investor, and our 50% equity will be diluted down to like theoretically 45%. So another 10% of our equity will be diluted down. More shares will be created, and investors will get the cap. Will be allocated those shares. That's generally how it works with a cap table. So a cap table is just everyone that owns anything in the company. Employees are on the cap table. If you're an employee that's been given shares, like you get 0.25% of the company, you're on the cap table now. You will likely, as an employee and a founder, you will have what's known as common stock, which is the average share in the company. So 10 million shares, there will be 10 million shares of common stock. That's what will be allocated to the founders and the employees. And then when an investor invests, typically they get preferred shares. Preferred shares are they're new shares that are minted on top of the company, on top of the equity. The preferred shares give the investors the right, when the company has an exit, to get their money back first. So preferred shares just mean I gave you money. If we ever make money off this, I have to get paid before you. And so, but everyone has shares on the cap table proportional to the amount of investment they made or the amount of equity they were given in the company, whether you're an employee, a founder. And so every fund, every angel investor, every employee is given a portion of the shares based off of, if you're an angel investor, you invest 50K at a $2 million valuation, you get X percent of shares based off of that percentage that you bought. And then you're put on the cap table. So that's the simple way a cap table works. It's literally just a spreadsheet at the end of the day. There's some math that complicates the spreadsheet in terms of like the dilution and all that kind of stuff and the shares that are created. But the simple way to think about it is just think of it like an Excel spreadsheet that just tells you who owns what in numbers.
It's actually very well done. I mean, I think in a minute or two, you actually broke this down in a very comprehensible, simple way. So,
Look at me now.
It's a perfect way to wrap this up. Yeah. So how can people get in touch with you? How can people find you and work with you or follow you?
Yeah, just follow like Jack Kuveke, Kuveke on all platforms, and Jabroni Capital on all platforms. Subscribe to the newsletter, or follow me on LinkedIn. And if you want to work with me in fundraising, you can just contact me there. I'm very accessible. But most importantly, like just go read the newsletter. That's mostly what I care about, is people following the brand and liking the content that we make. That's what I care about.
I mean, that's going to be the way that you're going to show off eventually that you're an insider. If you say you're, subscribe to the Jabroni Capital newsletter at one point. Then that final question for you, Jack, though, you talked about that you don't want to be in this forever in this game. Do you already kind of know? You already hinted at some things there. What are you going to be doing at one point? Are you going to sell courses for how to grow on LinkedIn, or like what's the next thing there?
I'm just trying to build a media company. If I build the newsletter big enough, we have a big enough audience, then we can sell things to that audience that are valuable for them. So, the newsletter is already at a point where we can sell sponsorships for a decent chunk of change. If we get up to like 100,000 subscribers, we can make a lot of money. It could pay for me, my lifestyle, for like, I could make, $500 to $2 million off that theoretically. So the goal is to just build a media company that's valuable, that people love and are addicted to the content. And then I can cash out and leave all you hanging. It's like, at the end of the day, it's all I care about. It's just selling out and disappointing my fans.
Well, like you said, New York people give it to you straight. They don't.
Yeah.
You know where you're at. Jack, thank you so much for your time. This is really cool stuff, and I hope for a lot of people that have never really listened to a VC before, or like someone who's in that area, in that industry. I think it was a lot of good stuff there, and very authentically, especially as you put it. So, thank you so much. If you could hang on for a second, just to make sure that your video is uploaded, and then yeah, thanks again.
Yeah, my pleasure, man.